Hey there, Nick Vail here, as always, helping you live your best financial life. By now you've probably seen on every news channel and every major publication the doom and gloom scenario that played out last week, the inversion of the yield curve. I wanted to put this brief video together to explain what this means and why it has investors concerned. So what is a yield inversion? First, a quick explanation of what happens when you invest in treasury bonds. When you buy treasury bonds, you're actually loaning money to Uncle Sam. Okay, the government uses the money now to cover operations and then pays you a coupon in the form of interest payments. Then they pay back the original amount you invested or the principal at the agreed upon term. Now these treasury bonds can come in many different terms. The term can be short, 2 years or less, or it could be all the way up to 10 years or more. Normally, when you invest in a short-term bond, you expect less of a return in the form of those interest payments, or what we'll refer to as yield. This makes sense, right? You wouldn't expect to get as much of a return for tying up your money over 2 years as you would if you tied your money up for 10 years or longer. This is where the yield curve comes into play. Typically, 2-year rates would be here, and 10-year would be up here. And there's a curve that connects the two. Okay. Now, a yield inversion means that the 2-year rates are now higher than the 10 years, hence the inversion. So now it costs more to borrow short-term money than it does to borrow long-term money. Now, there's a few reasons why the inversion can occur. Short-term rates could have been adjusted upwards, or investors may be skeptical about the long-term outlook of the economy, and they flee to safer assets, namely bonds. Now, as investors flock to long-term treasury bonds, the yields on those bonds fall. This is because they are in demand, and they don't need a high yield to attract investors. Now, on the flip side, the demand for the short-term treasury bills falls, so they are now needing to pay a higher yield to attract those same investors. Eventually, the yield on the short-term treasuries rise higher than the rate on the long-term treasuries, hence you have a yield inversion. So why are investors and the media in a tizzy over this inverted yield curve? Historically, an inverted yield curve has been a sign that a recession is looming. However, we've recently seen a few other can't-miss indicators that historically would be pointing to a recession that have not proven true. Also, when the inverted yield curve was an indicator in the past, it did not happen at a market top, and it didn't happen right away. The recessions typically didn't occur for another 14 to 24 months, and during that time, markets continued to rise. So what does this all mean? Who really knows? Could this time be different? Maybe. We're still seeing economic growth. Unemployment and wage data remain mostly positive. So it's always important to remember that financial media needs headlines. They need headlines to draw in your eyeballs and to sell their papers and get ratings. So how should you respond to this news? You shouldn't. Our clients have a foundation of a financial plan that maps out how they should invest when pursuing their goals. If you're taking the appropriate amount of risk and understand the timing of your goals, you really shouldn't worry about what's happening over the next 6 months to 2 years. What's important is to understand what's happening and to have a plan, but also to have someone in your corner that is a champion for your financial well-being. Do you know how your portfolio would hold up in a down market? Do you know if you're on track to reach your financial goals? I hope so. If you don't know, reach out to me. I'd be happy to chat. Until next time, I'm Nick Vail with Integrity Wealth Advisors. Have a great day.